Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen
and Pat McClain.
Thanks for joining us today. This is a financial program. Both myself and my co-host here, we're both financial advisors. Of course, many of you have been listening for a while, and you kind of know what we do, but we are practicing advisors, been practicing advisors for roughly 30 years each, and still enjoy the industry, obviously, and we enjoy being your financial advisor on the air. So whether you listen to us through terrestrial radio or podcast or whatever, we're glad you are part of our program.
So it's I spent some time yesterday on the phone with some of my clients, just kind of chatting.
And you have a handful of clients anymore, right?
That's right. That's right. I mean, the firm has thousands.
I mean, every once in a while, I had a friend reach out and like here's the challenge. Like, I don't even know how to use most of the current software, like in the office, right? I mean, and I'm on the road. He's pre-pandemic, I was on the road so much, and I'm going to be. But
I have a handful of clients that I still work with that I really enjoy the interaction with them. And in talking with them just yesterday, we normally would meet in person, but I was talking on the phone. I just realized how personal financial planning is. Just how really. I talked to 4 couples.
Almost no one shares their income, their net worth. I mean, people will talk about their sexual lives more than they'll talk about their
so not only that
finances.
So I'll give you a breakdown of 4 couples. One, they had gotten married 5-6 years ago in their early 80s, just kind of struggling through life. One just had lost her husband a couple years ago. The other had cancer. Another couple that
you can tell you've been doing this 30 years.
Correct. The gentleman had cancer.
These are people you helped retire 25 years ago or whatever. Yeah.
And they're on all different kind of phases of money. They're all comfortable. Some of them are much more comfortable than the others. But it's funny, the ones that think they're uncomfortable are actually the ones that are much more comfortable and vice versa.
That's the funny thing about money.
Right? Show me someone that doesn't care about money and I'll show you someone that doesn't have any. Right? So.
But in Solomon said, whoever loves money never has money enough.
There you go.
Right? I mean, it's like this. It's a very strange thing.
It's a strange thing. But the reason I bring that up is financial planning isn't investment management. Investment management is part of financial planning. It's not all it is. So in recent surveys, they asked people, what do you think your financial planner does? And over 50% said just investment management, which I thought was strange because it's all-encompassing. It's how tax and estate planning.
But then there are some quote-unquote financial advisors that are nothing more than asset managers,
good point.
Security selectors, or whatever you want to call them. I don't even know.
Good point.
They used to be called stockbrokers. Now they're all financial advisors.
Excellent point. But the reason I bring that up is, listen, we're a financial planning show. We own an investment advisory firm that's emphasis is in financial planning. And so feel free to call with your situation. And when we answer someone else's question, we're not answering your question. We might be answering a similar question, but it's not your identical situation. So if you'd like to join the show, it's 833-99-WORTH. That's 833-999-6784.
And I tell you, it's with the financial markets, like volatility finally returned. It's funny because people will ask me, like, we got some new lights in the studio. I'm just looking at what kind of fancy hanging lights.
Oh, now you know what
they're like decorative. I just looked over.
Now you know what
I'm
it's
distracted.
Now you know what it's like working with Scott Hansen.
Squirrel.
No, let's just stay focused on the radio show for at least the next 50 minutes.
But I mean, the market, it has over a long period of time, the returns are going to revert back to their mean, their averages, right? Stocks historically have averaged about 6 percentage points higher than the rate of inflation, 6 or 7 percentage points over the last 100 years based upon lots of different data, right? So, and if inflation's averaged 3%, that's why a lot of people talk about this as 10%. Stocks have averaged about 10% a year. So when we have these periods of time when we have excess returns, the longer that goes on, the more kind of concerned I think if it's eventually going to revert back to its mean, back to its average.
If history is any guide.
It's the only guide we have.
That's right.
So it truly is. And so anyway, when you see pullbacks, sometimes people say, "Oh man, it's been a bad day in the market," and actually, it's a pretty good day on the market. Like
because over the long term,
no one likes seeing their account balances go down. But let's remember that's a price that we pay to have those excess returns. If we never have things that go down in value, let's just keep our cash,
everything in the
and our nothing.
Yes, but that's right. The excess returns, risk-adjusted returns, are based upon volatility. That is the price you pay.
That's the price you pay
over time,
and you have to learn how to get comfortable with that and not get too emotionally attached.
We talked about this a few weeks ago on this. Does this not remind you a little bit about the .com with all this Dogecoin, Dogecoin, Doggycoin? I don't know what it is. Dogecoin, and Bitcoin, where Elon Musk can actually go on Saturday Night Live and affect the asset price of something that, by the way, is just created out of thin air. I read an article this morning about why Elon Musk thinks that Bitcoin is bad for the environment because of the electricity. Yeah. And you said it. What? I don't know if you said it on the radio show.
I think so. I don't know why anyone's now talked about it. I read these articles would talk about the power companies can tell the houses that are trying to mine Bitcoin. And I'm like, it doesn't seem too environmentally sound.
But wouldn't you think that that the less Bitcoin there is in a mine, the harder it should be to actually extract that Bitcoin from the mine? Whatever this metaphorical mind is, mine.
That's what's happening.
Yeah, it's just a strange world.
But when you think the value of all cryptocurrencies excess of $1 trillion today. So that's a lot of money, right? So you think about investors have bid up, put their faith in these digital coins to the point that the value of them today are greater than $1 trillion.
Which created from, so I said to my 20-year-old son yesterday, I said, and he trades cryptos. He was telling me, I wish I would have stayed longer in Dogecoin. I'm like, okay. Well,
that's always a great investment. I wish I would have. I should have. I almost did.
And I said, you kind of remind me a little bit when you were in the third grade when you were trading Pokemon cards. And he said, Dad, the Beanie Babies and Pokemon cards, there's not a lot of difference between that and cryptocurrencies. I said, at least with the Pokemon card, you had something you could look at. And then I thought, well, those are the NFTs that have now come out with the fungible.
Yeah. So the Beanie Babies, it reminds me of a time, this was 20-some years ago. When were the Beanie Babies hot?
I don't remember.
20-some years ago.
Yeah, a long time ago.
So we had a client come in. They had just retired. Basically, a lot of the process we go through, we do a financial plan, retirement plan, retired, the funds we're in, and we always like to have a separate meeting just to discuss investments, make sure they have a good understanding of what's going on, make sure they're comfortable with our approach, answer any questions. So this couple came in, they sat down, they say, hey, Scott, we have very little time. We're going to have to get out of here about 5 minutes because we are going to a Beanie Baby show or whatever it was, right? Some exchange, Beanie. And I look at him and I thought,
it's your life savings.
It's your life savings, right? And if you don't understand what's going on, there's a good chance you're going to make poor choices in the future, poor decisions.
Well, there was a degree of trust, obviously.
I don't want that much trust.
Well, that's a good point, right?
Just remind. Also, a time later, years ago, I told a lady that she was taking too much money out of her account. She says, "Oh, that's all right, Scott. I trust you to be able to get the higher returns to keep the account alive." And I'm like, if you want, trust me what I'm telling you, you're spending too much money.
Yeah, it's not magic. But anyway, back to this, I just feel like it's kind of a .com thing all over again with some of these things, like the Dogecoins and the NFTs and it's kind of crazy.
Well, you read all these stories about these people who have no experience of being investors. They start trading in these things. They develop these clubs.
Yes.
Not how you're gonna. First of all, it's not how you're gonna make wealth. It's not how you're gonna preserve wealth. We can always find the
transfer of wealth.
We can always find the story where it works out for somebody, but there's lots of stories where it doesn't work out. And unfortunately, building wealth's not easy. It's discipline, savings. It's typically made in your career, whether you're really good at your craft and the marketplace gives you a high wage, or you have a business. That's where people make their wealth. and they use the financial markets to store their wealth and get a somewhat of a return to help them with their future income.
Well put.
I mean, that's really what it is.
That's well
Because
put.
markets go through cycles, and we're going to have a cycle sometime in the future. I mean, look, for the last 25 years, we've had 2 times when the market fell by 50%. There's probably a good time in the next 25 years. We're going to have another couple of periods where the market falls by 25%.
You would expect that.
And we should plan for that.
Yes.
So who knows where the market's going to go over the next few months? Maybe it'll continue to march higher, and there'll be new SPACs worth billions of dollars.
Which is a special purpose acquisition.
But to put it in perspective, so the SPACs have raised about $100 billion, a tenth of the value of the cryptocurrency.
Which is crazy.
Right? And you look at what's going on in some
But
of
they
these.
didn't raise all that money with crypto
That's true.
either.
That's true.
Right? So it just got
It's
bid
just
to
bid,
that.
yeah.
It could be less than a tenth of that. Because what sets the price of the cryptocurrency is the
Greater
last
fool.
trade.
The greater fool, whoever.
Yeah.
It's the last, the
Goes
last
up that
trade.
fast. It'll go
Yeah, and
down
sometimes
that
you
fast.
see people will put some stop loss orders. Well, I'll sell if it drops to this price. But something can fall from $100, and the next trade can be $10.
Yeah, and the stop loss, by the way, in any asset is when you trigger the price. It's not
That's
you're going
right.
to get for it.
There's no guarantee on that. Anyway, let's 833-99-WORTH is the number to be part of the program. Let's talk here with Ray. Ray, you're with Allworth's Money Matters.
Yeah. Hey, guys. Thanks for taking my call. I'm really excited to chat with you. My basic question is, how do you suggest that I can tell when I have enough for retirement or that I could retire? I'm 57. I always thought it would be cool to retire in my 50s. My wife is 55. You can't take it with you, right? So I feel like, whatever years I have now are statistically going to be better than the ones, 5 years from now. So, how can I tell when I can stop coming to work?
We'll walk you through a quick and dirty.
And actually, there's actually a lot of studies that people are like their happiest in sometimes their 70s, but I think you've got more than 5 years of good
but
life
what
ahead of you.
what I will do is tell you to go to our website and look at anything that says personal decision points or the 7 personal decision points for retirement transition. It is a process that we actually have designed in order to determine whether you have enough money for retirement.
Because there's a lot of rule of thumbs out there. You need 80% of your pre-retirement income. Some say you need 90. I've seen some you need 110% of your pre-retirement income.
But I can walk you through something quick and dirty. And by the way, you think long and hard about retirement before you retire, about your lifestyle, because that's probably more important than anything, and how you're going to fill the day. So how much are you making now? Did both you and your spouse work?
Yeah, we both work. We're close to 200,000, and that's the hard part, right? We're literally at the pinnacle of our money making capabilities of our
50s.
life.
I imagine your kids are grown and gone, or pretty much self-dependent.
All grown and gone. Yeah.
Yeah.
All, knock on wood, self-reliant. Yeah.
And Ray, what is your income?
I'm at about 160.
And what's your spouse's income? 40, because I'm quick at math, right?
Yeah. Yeah.
Showing off.
Got it. And do you owe on your home?
We owe about 170. Probably there's 300 in equity in it. So
Okay.
it's
How much money do you have put aside for retirement?
So we have, rounding a little bit, we have about $1 million in an IRA, a 401k, and then another $500,000 in it's in brokerage, it's in Roth, it's in cash.
And are you going to
things like
receive a
that.
pension?
No.
And what was your income, say, 5 years ago? Have you been at this level most of your career, inflation adjusted?
No, I mean, I would just say it's been steadily ticking up. Occasionally a good year, but I've been, I think, highly compensated.
And how much do you save?
For a while?
How much did you guys save from last count? Well, last year was a weird year, but
Like in your 401ks, do you put the maximum?
Close to it.
Okay.
Close to it.
And do you have any other assets?
We have like one little rental that throws us $500 a month in income.
So I just tell you, quick and dirty, you don't have enough money to retire comfortably.
Well, not to replace your standard of living.
Not to replace the standard of living. So if you're living on 100% of your after-tax and after 401k contributions income,
well, how much? I mean, are you saving quite a bit so you're not maximizing your 401k?
We're close to it. I would say for the sake of this, yeah, we are.
okay.
Okay. And then are you?
And I know how much I spend. I spend $100K a year.
How much money do you have in the bank then?
Well, just in bank accounts or cash accounts.
Yeah.
Probably $150,000.
Okay.
So you spend $100,000 a year. Does that include what your mortgage payment is?
It includes every single thing.
Okay.
All right. So here's what you may be able to retire, but there's a couple things I would actually walk through right away. Right. One is, why do you have $150,000 in the bank and $170,000 mortgage on the house?
Yeah, that's. I mean, I didn't want to take your whole show, but that was the other thing is that sometimes we look at each other and say, well, why don't we just pay this thing off? Right?
Would you lend?
And interest rates like 4%.
You wouldn't. Correct. You wouldn't lend the bank money at 0.25% and borrow it back at 4%. And that's what you did. So here's what you may be close. You are on the edge. You most certainly can retire in the next few years. Most certainly retire in the next few years. Go to our website and look at the 7 personal decision points. And quite frankly,
we've got on there. So we've got guides on there. We've got webinars on there. It'll help. I mean, what we really need to figure out is, you spend $100,000. Okay, so that's pretty good to know that. Like, if we can take care of the mortgage, now we're maybe looking at $80,000. So we have, and once we pay off the mortgage, let's call it $1.3 million.
Right, and then if we're living on $80,000, right? How much money do I actually need in order to generate $80,000?
And the $1.3 million is not going to generate the $80,000
between now and Social Security. Whenever Social Security starts, which is a whole different set of decisions, which makes it unlikely that you could retire today, but you most certainly, with a little bit of planning, could retire in 2 to 5 years very, very comfortably. And the closer you get to Social Security, the easier it will be. The closer you get to zero debt, the easier it will be. So I would recommend you actually go to our website, allworthfinancial.com.
And then also, Ray, are you confident that you'll quit and never work again?
Yeah, I'm not confident about anything.
I like the honesty. I mean, most of us, we plan certain things in our life, and then life happens, and we end up in situations that aren't quite
I'm sorry, Scott. You've done great, though. You've done great. You just need to clean it up around the edges and then pick a real date and then plan to that in the future. So go to our website, and if you want.
And it might be that, I mean, look, over the years, I've had people say, I can't do the grind I'm in. I can't continue this career, this path I'm on. It's going to kill me. So I'm willing to sacrifice a little bit in standard of living to retire early. Right? I've had those discussions to help. I've had others say, I can't do what I'm doing anymore, but I'm happy to go do something else. I actually don't want to do zero work. I'll do some consulting for a period of time. And then I've had others say, look, if I don't have a high degree of probability that I can maintain my standard of living, I am not going to retire until that date. I never want to ever have to think about going back to work. And they're different. Everyone's got different thoughts on it.
And a good financial advisor will actually have that discussion with you and do what-if scenarios. What if we did this? What if we worked another 2 years? What if we retired today? What if we paid off this mortgage? That's what a good financial plan does, is plans for what ifs, because nothing is certain. As you said earlier, nothing is certain, but the greater your confidence in the outcome, the more certain it becomes. But nothing's 100% certain. So that's why.
I mean, and I think. Sorry, I was just going to say, if you have a good enough runway, then you don't even worry. Like when the market goes down 5 or 10%, right? You're not like near the edge.
Exactly.
And then now you have the stress of I'm not working. Yeah.
Well, and part of that too, Ray, is just the way you have your portfolio allocated. I mean, there's different ways to think about it, but typically, let's assume you've got at least 5 years of income that's not tied to the stock market, right? Let's say. Well,
yeah.
Markets have almost always recovered within 5 years if you go back over history. So it gives you plenty of breathing room. So when you see the markets off 5%, 10%, 25%, 45%, when they go through those down times, You can say, oh, that's really painful. I don't like seeing my account balance go down. But you can say, I've got pretty good confidence that the world is going to continue to spin. I have pretty much confidence that the markets are going to recover, and you can ride out those ups and downs. Much easier to ride out the ups and downs while you're working, right? And saving than it is when you're retiring.
So either that or hire a good quality financial planner and pay for a financial plan. There's many firms out there that do just like we do. Although we think we're
I'll have to check your website.
we think we're the best, but how could you not? We might be biased. So appreciate the call.
Yeah, thanks, Ray. Wish you well. And I even kind of.
But Scott, before we leave, Ray, pay off that mortgage. I mean, take the $150,000. He's got $500,000 in a brokerage account.
I mean, the bank should be sending little personal rate and thank you notes.
There's a picture of Ray in the lobby. The bank.
I remember years ago I had a client. They had a collateralized loan on their own cash. And they had a loan that had a higher interest rate than the money that they were paying in their CD. This is a long time ago. And I've read about this, but I'd actually never seen it. Like, why do you have this? They couldn't give me a good answer.
Who in the bank thought of that? There was accolades all over the place for the bank there. It's like, we're not actually going to borrow money from someone else. We're going to borrow it from our client and lend it back to exactly the same person at a higher interest rate.
Right.
And if they want to get at it, they actually have to pay down their mortgage. You're like, wow.
Well, anyway.
Finance is hard for a lot of people. It is not how a lot of people. I went to lunch with our marketing people a couple weeks ago, and I went to lunch with the finance people.
Very different lunches.
Completely different lunches, right? So I have a foot in you have a foot in both worlds. So you can move between worlds, but just very, very different lunches. What they talked about, the conversations, how we sat there after lunch for about a half hour, just catching up. In a post-pandemic world, we're allowed to actually come back together and eat.
Well, and so first of all, there's people that struggle with finance and numbers. People are intimidated by their finances, intimidated by the financial markets. But then there's also the fact that investing is hard. I mean, it's not that formulaic, and one could do all the planning in the world. They buy some investment, and it goes down in value the next day, and it makes no sense from just a logical standpoint. You look at why did this go down or how could it? So, I mean, sometimes particularly younger engineers sometimes have a hard time when it comes to investments because they run these models this is what's supposed to happen. How come it's...
But bridges fall down sometimes too.
Yeah, but come on.
But
that's not a very good analogy because if a bridge is designed properly, it won't come down.
Which is a difference between an investment and a portfolio, a diversified portfolio. An investment, when I think about an investment, it is a single issue. It's an individual stock or an individual bond or an individual mutual fund. Am I thinking wrong? Versus a portfolio, a well-diversified portfolio has many parts to it.
That can still go down. It's not going to collapse like a bridge. Could collapse in a bad storm.
Okay.
That would not.
I don't know if that's the best analogy, but we're trying here.
Yeah, we haven't had the bridge analogy in the past, and we've been doing this a long time. I did. My wife and I celebrated 29 years of marriage a week and a half ago. So.
Congratulations!
Thank you. 27 good years.
I don't know. I went to your wedding. I had to sit in the reception. You had me at the very back of the room.
I had my good friends up front.
I didn't.
Someone has to be in the back. I thought you were like a giver. You would understand.
I actually did. I actually understood completely.
It wasn't that big of a wedding anyway.
No. Anyway.
But we were married in the Bay Area, and so we stayed a couple days in the Bay Area, and I went for a run across the Golden Gate Bridge, which I've done a handful of times in my life, and it's always fun.
Speaking of
West
bridges,
Coast, walking across that bridge, running across the bridge, riding your bike across the bridge. You can get these e-bikes now to make it even easier. Cross the bridge. I don't know why I brought that.
Or you could drive across the bridge.
Or you can drive across, or you can look at the bridge.
We've run this bridge analogy into the ground.
Yeah.
Hey, let's talk about, Scott, how people can subscribe to our weekend update. So before every show, we get notes from our marketing department. And on the marketing notes, exactly what it says today is consider signing up for our weekend update. We will email these articles to you every Saturday, and you'll get them once a week. And you can sign up at the bottom of our post.
And in all seriousness,
we put a lot of time and energy into it.
Yeah, there's usually 2 or 3 articles. They're topical, and they tend to be around. They're not financial market reports. It's not like here's what happened in the stock market this week, because it's kind of irrelevant for long-term planning. It's more of here's some of the latest trends in retirement planning, retirement distribution, state planning tax issues. It really covers the gamut there.
So you would find this at allworthfinancial.com at the bottom of the homepage at allworthfinancial.com to sign up for our weekend update.
That was called the weekend update.
That's what it's called.
We're going to take a quick break. When we'll come back. We'll take more calls. 833-99-WORTH is the number. Be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Having fun here on the program. You know, it's interesting. I think we have more listeners now via podcast than terrestrial radio. And, years ago we still have a hard stop halfway through the show where it's timed to a hard stop. And the shows that are pure podcast, they feel like they have a little different flow. So we're trying to navigate both worlds here. And,
yes, because we do both terrestrial and podcast.
Yeah. So, let's talk here. Let's go back to the phones. We're talking with Mariana. Mariana, you're with Allworth's Money Matters.
Yeah. Hi, Scott. Hi, Pat. Thanks for taking my call.
Thank you for joining us.
I will be retiring at the end of this year with a PERS pension, and I've been looking at the options I have available, and I'm considering 2 of the different options. One is 100% beneficiary, and the other one is a pop-up provision.
Mm-hmm.
And I wanted to get your thoughts on how do you decide which one of those to take?
So for the rest of you, PERS is a public employee retirement system. I think you're from the state of California.
But there are hundreds and hundreds of these across the United States. And
it's the same.
Similar benefits.
Which essentially you go to retire and you have a pension. Your option is just pay for my life only, 100% for me. I die, too bad for my beneficiaries. By the way, if you take that option, the beneficiary has to sign off on it. If you're married, I should say, your spouse has to sign on it and allow for that. Or there's typically a variety of different options. Give me a little bit less if I pass away early, pay half to my spouse. Give me even less if I die early, pay 100% to my spouse. Or an option that Mariana's thinking about, give me less, but if my spouse predeceases me, let me have my pension pop back up to what I was supposed to.
So the answer to the question is actuarially, they're all the same number.
Well, actuarially based on a large pool, non-medically underwritten. So
that's okay. Thank you for finishing that, Scott. 100% right. Non-medically underwritten, which means when they offer you the pension, think about it in life insurance and in I don't know if I can explain this well, but life insurance in reverse, which is if you bought life insurance today, they would medically underwrite you to see if you had a shortened life expectancy or a longer life expectancy to determine how much premium they're going to charge you.
And if you're smoking 2 packs a day and drinking a fifth, and
they're going to charge you a lot of money. This is exactly the opposite, which is if you have a shortened life expectancy, right? You want to actually take as much survivor benefit to your spouse as possible. If your survivor has a shortened life expectancy and you have a long life expectancy, then you want to take the longest, biggest payout to you as possible.
And from your pension, they don't go and say, "Hey, Mariana, we need you to take a physical. We need your spouse to take a physical, and then we're going to give you the numbers." They're just basing on large averages.
Right. So the question now
Well,
is,
can I? Is there a way to calculate the payback time if I give you the numbers on?
nope. I could if you could tell me the day you and your spouse were going to die.
Well,
That's the challenge.
I mean
That's the
between
challenge.
the
So it comes down to life expectancies that we're just talking about, and also needs. So if you have several $1 million in investments, well, you might say, let's just give me 100% pension, and spouse certainly doesn't need it. If you have no other assets whatsoever, you're like, shoot, I pass away early. My spouse really is going to be in dire straits if I don't have a pension continuing for them.
And what's interesting is you gave us 2 choices when there's about 7 that are offered to you.
right, but I'm not. I want my spouse to be covered if
Got it.
if I pass away because he took the lump sum when he retired.
Okay.
So
Okay. So
either one of these scenarios is enough money for us to live on without even touching our 401ks.
thank you. Thank you.
But I'm just not sure, if I should take.
Are you of similar ages?
He's 6 years older.
Okay. And are you both in good health?
I would say I'm in a little bit better health. He's got a little bit of an underlying condition, which could turn cancerous someday, but it's been stable for the past 10 years, so
And
could be stable for the next 10.
And what are
he's
the price
68,
differences?
So
What are the price differences?
100% beneficiary, I would get $96,190 a year. If the pop-up provision, I'd get $94,720 a year. But then if he passes away,
Yep.
it would pop up to $100,570.
Yeah. Take
You
the
want
pop
option
up.
2.
Yeah, take the pop up.
In part, and right when you told me the 6 years
pop-up?
the 6 year age differential,
Yeah.
that right there gave it away.
Yeah, the 6 years and the underlying health condition, take the pop up.
Okay, that's
I mean, from a
what I've been struggling with.
statistical standpoint, he's going to predecease you.
Yeah.
First of all, women live longer than men. I mean, I hate to say it, but 90% of the time.
That's what I thought, but I wasn't sure if there was I could calculate a payback time. Like
Yeah, we
if
can.
you did
We can run the
predecease
numbers.
me, I would.
It's going to still tell us the same answer because the 6 year differential.
So your suggestion would take the pop up.
100%.
I would take the pop up.
No question.
Wouldn't even.
It's
Okay.
In fact, I apologize for wasting all that time talking about how they work. You should absolutely take the pop-up. Don't give it another moment's thought. The differential to you is less than $2,000 a year. I could actually run a calculation. We're going to come up to the same answer on the net present. So what happens is if we ran it through this.
The difference is only a little, like you said, it's less than $1,500 a year, but then it pops up to $5,800.
That's right.
You know, if
and the
he
reason it pops up.
passes away, and yeah.
The reason it pops up that way, Marianne, is because they actually look at that you're going to live a similar lifespan, right? And so that they're only going to pay that extra $6,000 a year for a short period of time. But more so, Scott thinks it's about the 6 year difference, which has a role in it. The underlying health condition is the driver for me.
Okay.
All righty?
Well, those two factors.
That's really
It's
helpful.
both of them.
But I mean, the 6 years is right off the. It's that check the box right off the bat.
That's right. That's right. Easy decision.
Yeah. Hey, congrats on retirement.
Appreciate the call.
All right. Thank you very much.
All right.
Appreciate
Take care.
it.
And
Love
hope, by
your
the way,
show.
hope you both live a very long life, and you think about it down the road and think, dang it, I shouldn't have listen to those guys. I should have taken the higher amount and not dealt with the.
Good problem to have.
Yeah.
Good problem to have.
All right, Marianne, appreciate the call. And the reality is, women need to plan for their financial futures. 90% of the time, the men go before the women. And so, I mean, this particularly at retirement time, it's important that both spouses, if you're married, that a couple does this planning together. They both understand and what's going on with the investments. It's funny, my wife, she has a degree in finance. That's where I met her, in finance. Back then, there was about 8% of the students were women, and the rest were men. About the same it is today, by the way, in the finance class. So I met her, and she's quit the workforce when our first kid was born and has stayed home as a mother, and we still have kids at home. And she has zero interest in our finances, zero interest in our portfolio. And I literally sit her down a couple times a year to say, look, we're going to look at this together. Here's where things are.
How's that go?
She's disinterested.
I know, but you think it's that important that you would put her and you through that pain. You're a good husband. It is that important.
It is that important because, look, I don't know what happens tomorrow. I get killed or something. She's got to figure this stuff out.
Oh, I know exactly what would happen tomorrow if something
call
happened
you.
to you. Call
Well,
me.
she's lucky. All right, most people aren't married to a financial advisor. Yeah, that's.
But in saying that, in fact,
By the way, my situation's a mess too. You'd have a good time.
oh, Scott. So in saying that, I had mentioned earlier in the show how I had talked to some clients yesterday. In talking who was the trustee of a trust, we decided it shouldn't be any of this client's children. It should be another relative, because both.
What are you getting at?
About who you should be sharing the financial information. Most families name their one of their
Oldest kid.
children. Normally, their oldest kid is the trustee of the trust, and
Not
that
my oldest kid.
oftentimes
It'd be spent.
right. Oftentimes, that's not the right decision. That's what I'm getting at.
Yeah, it would be gone quickly.
They're all different, aren't they?
Should be enjoying life. Woo. It's funny watching people.
Don't you wish you had a little bit more of that in you, though? A little bit more carefree? Don't you? Well, I guess you can't really wish away who you are.
No, that's one of the things I've actually tried to get as I get older. Is resolve that this is just me and parts of me aren't going to change.
That's right.
All right, let's go back to the calls. 833-99-WORTH is the number. We're talking with Diana. Diana, you're with Allworth Money Matters.
Great. How are you?
Hi, Diana. How can we help?
Well, my question is, what is the Monte Carlo method of determining asset allocation for retired people? I've gotten two radically different allocations from two investment management companies I interviewed.
Mm-hmm.
The first had me fill out a questionnaire about sources and uses of funds and determined that a split of 30% fixed income, 70% equities was appropriate. The second firm asked fewer questions and plugged me into a 70% fixed income, 30% equities scenario. Based on the assets in the account, both charge a 1% annual management fee.
Mm-hmm.
A year ago, I went with the first firm, which moved me out of several successful stock positions into EFTs, which was fine. And based on what they did, they decided that I now had a 95% chance of not outliving my funds.
Mm-hmm.
That's nice. I was fine. Then the person who did this went to another company, and I didn't like the person they assigned me to.
Okay.
How accurate, how much trust should I put into
first of all,
Monte Carlo?
I apologize for the experience you've had in our industry. And it sounds like these have been driven primarily from just plain investment management and not so much on financial planning.
The first people were more financial planning.
The ones that had a higher allocation towards equities, which over the long period of time should yield you a much higher result.
Exactly.
And did they both call it Monte Carlo?
They both called it Monte Carlo.
Okay. So it's, when you think about Monte Carlo, it's the
The
underlying.
whole name sounds weird.
It sounds like you're just
Name
like
doesn't
spinning a
hold
wheel,
together.
right?
Yeah.
Yep.
oftentimes it has to do with their underlying assumptions of what they actually think long-term interest rates are. There's a number.
I'm not a big fan of Monte Carlo simulations, by the way.
Yeah.
And the reason is sometimes they'll show that somebody can't retire when they probably can. They might show that someone needs to take on more risk in their portfolio. But the real factor is what I've discovered, Diana, is over the years, their spending does not live in a vacuum. So when the financial worlds are struggling, even if you think back to the financial crisis, what I found is people that have lots of cash felt foolish about going out and spending it on things. If you look at vacation travel or travel for retirees, where things were way down. It's just when things are not going well, people just tend not to spend as much. So the income needed from portfolios isn't necessarily static and grows by inflation every year. It depends on a lot of other underlying factors. I think it sounds like the challenge you've got now. You liked the guy you were with before. Is that right? Option one, you've been with a year?
Yes, I did. And I actually found this person at her new place of business. Unfortunately, it's a much smaller place. And the sense I had was that she was really good at plugging numbers into her computer program, but the underlying investment expertise,
Yeah, who actually made those decisions?
Who actually made those decisions?
It wasn't her?
It sounded like there was only one person. Wasn't her. And, I understand the difference between a portfolio manager and an analyst.
And the firm you were with that she was with, was that a larger firm then?
Was quite a bit larger, but they put me with some guy who really hadn't done his homework before he talked to me. And
can you see about interviewing a couple other advisors of that firm?
It's the same firm, or did you move the money already?
Oh, the money. I moved the money already.
Okay, and so now your portfolio
I'm out of there.
And now your portfolio is 30% equities and 70% fixed. Is that right?
Well, as I was really looking at it, there's about not quite still. There are a lot of long-term gains there. So they moved. Yeah.
So they kept a lot of your positions there.
They kept, yeah.
Good for them.
Close to 60. Yeah. Well, I had a little bit to do with this.
Okay.
But about 60% of it is in corporate stocks. About 35, 38% is in EFTs, and the rest is in bonds or short-term money funds.
Okay. And how much money are you taking in income off of this on an annual basis?
Probably about a 7% payout, maybe 8%.
Is that...
All of a sudden I have to replace the roof. That kind of is a pain.
And how old are you?
66.
And did you start at a 7 or 8% distribution?
Well, when I do it myself, I just sell things.
Okay, yeah,
and,
understand.
Pieces of this and that.
And
yeah, pretty much.
You're 66 years. Are you married?
No.
Are you on Social Security?
Not quite yet.
Okay, and do you own your home?
Yes.
And is it paid for? And how much of this money, and what's the account balance approximately?
About $1.1 million.
And is it all IRA or some of it out of IRA?
None of it is IRA.
None of it's IRA. Did you inherit this money?
It's in a trust, a generation skipping trust that my father set up.
Okay, so here's what you need to do. You need to lower your distribution immediately and start Social Security.
Yeah, that's on my list.
No, there's no list.
Mm-hmm.
It's not a list.
I know.
I mean,
I know.
Your distributions, I don't care if you're 80% equities, right? Your distributions at 8% are too high.
In this market with interest rates at 0.
It's if you've gotten there over time, because of the allocation and haven't addressed that, you need to address it now. But there's no. So what happens is someone should have just said to you, "Look, Diana, you need to lower your distributions. You need to set them up on a monthly basis. We need to actually put together a budget. You need to start Social Security."
Well, the reality is, with Social Security coming in, you wouldn't need to have to take as much, and then you could afford to have higher allocation towards equities.
That's right. Exactly. That's why you need to start Social Security immediately, is so you could lower these monthly distributions. Mm-hmm. And the idea of you're just going to sell something when you need money, that's not a plan. That's a reaction.
No. I mean, there are things that, I have too large a concentration in healthcare, for example, or too large a concentration in one stock or another. It's not just, oh, gee, let's sell something.
No, in my humble opinion, you're approaching it from the wrong direction.
Okay.
You need to actually figure out how much income you need to live on, and it can't be 8%. You need to start Social Security.
Oh, there is a TIAA CREF account, too.
How big is that?
About $200,000.
Okay.
It helps. And are you taking money from the
Did you not have these conversations with the advisor?
You should be taking money from the TIAA CREF account before.
Yes, I am. I'm taking I think $20,000 a year from that.
Okay. You got a little bit of
10%?
Well, but then for tax purposes, it seems a little high, though. You need to you go shopping for an advisor.
You're not. It sounds like you like the old person. She went to a tiny shop. You're not confident in the shop. Didn't like the person. I mean, look. You shouldn't be having to call a couple guys who run a show on finances to get answers. I mean, you should be able to have a relationship with someone where you got the confidence that they tell you. First of all, a good financial advisor is going to have these hard conversations with you,
don't take that much money.
I know you're thinking about it, but you have to do this now. I mean, frankly, there are times when we say, look, if you want to you want to be a client, this is how. If you're going to have to follow our advice in some places, otherwise it's not going to work out for any of us, right? So I think it's kind of your point
anyway,
there. But
you need to start Social Security immediately and lower that monthly distribution. Then land on a portfolio that actually, forget about the individual equities, just land on a portfolio of ETFs and mutual funds that's going to actually weather the test of time. You probably want to set
if you're overweighted in any sector, I would reduce it to there's
you
more
want to
risk
get your
in
distribution at age 66 down to less
she
than 5%.
might want to not take any money out of the TIA CREF this year. It triggers some capital gains by selling off some positions that are too large in a portfolio. Start the distributions again next year,
or why wouldn't you? Yes. There you go.
Because there's no capital gain taxes
for a period of time.
So I mean, there's a lot of tax planning that needs to go into this. The Monte Carlo, that's just some tool that some advisors use that I don't even know why you need to know. Anyway, all right, let's continue. I appreciate the call. We wish you well. Let's talk with Jay. Jay, you're with Allworth's Money Matters.
Hey guys, how are you?
Good. How you doing, Jay?
Good. I have questions about some 529s I have open for my kids.
All right. Good for you.
Okay. So I have two sons, age 5 and 9, and we opened 529 accounts for both of them when they were born. Right now, combined, there's $83,000 in there. So I'm trying to figure out, should I stop automatic investments and just let interest compound, or should I keep going with automatic investments?
So here's what I did with my children, Jake. I've got 4 kids. 2 are through college. The ones through college, I don't know, just maybe they're probably around the same age. I ran through the calculations when they were born, but then I went through the calculation and decided this is how much. I said, if they were starting college, how much would I assume that's going to cost, right, in the future? So 9 years. Let's say I have 9 years left for the 9-year-old. Then I said, how much is there today? And I just worked backwards. Like, okay, what's the net present value of that today? How much should I have today?
What's an assumed rate of return?
Right. And then it told me exactly how much I should have for Jessica, exactly how much I should have for Blake. And frankly, when they got to college, it was almost perfect. What I didn't calculate is the added expense of flying back and forth to Boston to see my kid, and then my wife liking to go shopping in Boston when we were there seeing him and going. So that part I didn't factor into the cost of college.
But the 529 plan won't pay for shopping. We know that.
Yeah.
And I don't mean to just throw my wife under the bus in there because she's not like a big shopper type person. But anyway, that's just what my reality was when my son was in Boston. So it's really a pretty simple calculation that either you find a calculator online to do, or
But at 5 and 9, you should continue to fund
work
these.
with a financial advisor.
You can do the calculation. You're going to continue to fund these at $83,000 and for a 5 and 9 year old.
Yeah, one's 9 years off.
Yeah, you're going to continue to fund these. And remember, you can actually change the beneficiary of them at any time to someone else.
Yeah.
So you can take them to a grandkid. You can keep it in the name. They're kind of funky as how much flexibility they actually allow you to have with the names.
There's some strange restrictions. You can only change a beneficiary once a year, allocations once a year.
Yeah. Yep, exactly.
Things along those. I mean, you can run the numbers or have someone run the numbers for you. It's a pretty simple calculation and it'll tell you exactly. But to Pat's point, like it would still tell us how much you putting in.
Right now, I'm putting $300 a month.
Yeah, you
combined.
You got a ways to go.
Yeah, I'd keep going.
Call us in back. You could do the calculation, or you could call us back in 5 years. And
I
ask
wouldn't
the same
stop.
Question.
Okay, great.
I mean, unless you're having some tremendous sacrifices elsewhere in your life and you can't afford other things.
No, I was just thinking about should I be putting into like more money into my 401k or opening a brokerage account with that money.
What percentage are you putting in your 401k?
Right now, I'm putting 6% in. It's getting the full company match. I have a decent amount already. I just switched careers and took a little bit of a pay cut, so I started a little bit lower. But
keep funding it.
But
keep funding it, and as your pay goes up, increase your 401k contributions.
Great. Thank you, guys.
All right, appreciate it. Thanks, Jay. Hey, we're almost out of time. We have set aside a couple hours to answer some phone calls on where'd my little sheet go?
On May 26th from 3:30 to 5:30, and you could call 833-999-6784.
Yeah, again, that's May 26th, 3:30 to 5:30. We will be in the studio answering calls. May 26th, 3:30 to 5:30 Pacific Time, 3:30 to 5:30 Pacific Time, May 26th. Questions at Money Matters. To get more information, then you'll see it on our website. We're out of time. It's been great being with you. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.